Well, let's head to Kenya now, where nearly 2 years into its implementation, the country has formally proposed that a rate cap law be repealed. Even though lending rates were already falling before its introduction in September 2016, the law has practically frozen most of the private credit market. Now, in other sectors like agriculture, lending has been shrinking each month in the 12th month to April. Non-performing loans were up about 12.4%, and they made up 12.4% of that total portfolio. Earlier, CGTN's Ramah Nyang assessed the damage the rate cap has done and what would change if legislators agree to repeal it.
Credit growth has deteriorated down to the point of is now about 2% or thereabouts, or even lower actually. If you look at the impact it has had specifically on the banking sector, the response from the banking sector has been such that, for instance, the number of accounts have significantly decreased. So we're talking about 1.3 million accounts that have been closed in view of the law coming into effect.
Let's interrogate that number a little further, because when we say these loan accounts have been closed, and yet on average the effect of the rate cap would have been to reduce the cost of servicing debt, why did these accounts close down?
Partly it's because of the fact that these are entities that could not access credit. So what tends to happen is that if somebody, for example, is already accessing credit, at the point when it's fully repaid, you do not access additional funding, and therefore you end up closing the account. On average, what normally happens is that accounts are repaid, either you get an additional loan or additional accounts come in. So as some are closed, some are opened, and the increasing number of new access to loans, then increase the number of loans available, number of accounts that have got loans available. But there are two parameters to it. There is the number of accounts that have reduced, which is looking at the number of accounts that were borrowing at the time when the law came into effect. And the last count that we did, it shows that they have decreased by 1.3 million. But also the size of the loans have actually gone up by almost 47%. So it means that effectively the banking sector is preferring to lend to the larger tickets than the smaller tickets.
If the rate cap is repealed, as the Finance Treasury wants to do, what then happens to those who have existing facilities that are essentially at rate cap rates, right, 14% essentially and below? Should they expect an uptick in their rate, an adjustment in their rates, or will that adjustment only apply to fresh debt?
Once the caps are removed, the rates will be basically market driven. But on the other hand, I think the banking sector is also conscious of the fact that you have got to behave responsibly post removal of the capping. So there is an impression that has been created in the market of the fact that when the caps are removed, rates will go back to where they were pre-capping. And I think that's not likely to be the case. There is a lot more sensitivity towards being mindful of consumer protection issues. And therefore, even though the rates are bound to increase in the market, if the portfolio is repriced, they are likely to be repriced to the levels where they were before.
Given the fact that now you're also operating under IFRS 9, which requires much higher provisions for any debt that's coming out of your books, we're not likely to get back to those heady days of 20% plus private sector credit growth, are we?
Yeah, I think where it might have a significant impact is on the lower end of the credit market. You see, especially the SMEs and the households, where the risk profile is enhanced, and therefore under IFRS 9, you have got to book upfront provisions that ordinarily under IAS 39 you would not have had to book until the default is incurred. Under IFRS 9, you have now to anticipate that and book it in advance. So the tendency to move away from the high risk segment because of the impact of the provisions earlier on in the transaction is much higher. What I see happening more is the fact that nothing stops you from pricing that risk accordingly if the caps are removed. It will be in a different picture altogether if we had IFRS 9 and then the caps in place.
Which is what's happening now.
Which is what's happening now. So if the caps are removed, it means that the banks can appropriately price right at inception that credit facility, and as long as there's no limitation in terms of how you can price it, then you price it accordingly and book it. So I don't see much of a change if the caps are removed.